Everyone. The last time I was in this room was on St. David's Day in 2015, and I was interviewing the new managing director of Waitrose in front of about this sort of number of people of Waitrose managers, and I thought, crikey, they look an intimidating bunch. They've probably seen my type before. So I brandished my Waitrose card at them to get them all at home and get them on my side. So I don't know what to do with you fellas and ladies and gentlemen. Maybe brandish my credit card. But a lot of you may not have seen a journalist before in real life, and I realise that we can be somewhat disconcerting at times, and that's very common. Old Fleet Street friend of mine had to go many years ago and knock on the door of the late Spike Milligan, and he turned up at Spike Milligan's address and knocked on the door. Milligan opened the door and he said, "Mr. Milligan, I'm from The Sun." And Milligan said, "Welcome to Earth." and that guy later on went to work for the News of the World, a paper that sadly no longer with us, but some of you might remember. And he had to go and report on a society scandal. And it was an old dowager in Chelsea, and he sort of knocked on the door. And this old lady sort of opens the door and said, "Yes." And he said, "Madam, I'm from the News of the World." And she said, "How do I know you're from the News of the World?" And he said, "Madam, I've admitted it." So the main thrust of the next half hour or so is our regulatory question time, but I've been asked to just sort of give you a few thoughts on the state of the world right now as I see them. And it's actually been a really fascinating year. I mean, just to take you back 6 months, if we'd been sitting here at the beginning of the year and you'd been asked, what do you expect for the next 12 months, you'd have said, well, for the first 6 months of the year, you'd have expected probably an interest rate cut from the Bank of England. You'd have expected probably 4, maybe even 5 interest rate cuts from the US Federal Reserve. You'd have probably expected to get one from the European Central Bank. And here we are, almost in the middle of the year. We've had 1 rate cut from the ECB, nothing at all from the Bank of England, nothing at all from the Fed. And I think that really brings home a couple of things. First of all, certainly in the United States, the resilience of the US economy, which just carries on motoring. The latest non-farm payrolls figures, 272,000 jobs created last month, way in excess of what Wall Street was looking for. So it goes to show that there is a good deal of resilience in areas like consumer spending in particular. I mean, 30 years in financial journalism has taught me you never ever bet against the US consumer. But also that inflation doesn't come down often as you might expect it to. And obviously inflation expectations were driving in turn these interest rate expectations. And inflation does not come down in a straight line. It's one thing I try and reinforce to the viewers all the time. You've certainly seen it in the United States. Inflation has not come down as rapidly as expected, and it even spiked up. And we've seen that, for example, in Australia as well, another country where, again, rate policy has not necessarily gone to market expectations as we'd have seen them at the beginning of the year. So in this country, we're in quite an interesting period now in terms of data. Last week, obviously, we had the jobs figures, and again, you saw wage inflation coming in slightly more resilient than expected, 5.9%. And again, that is way ahead of where the Bank of England, I think, would have wanted wage inflation to be right now. We also had the April GDP figures, and obviously the main headline there was that the economy flatlined during April itself. Not really a surprise when you think back to what the weather was like in April. And the Office for National Statistics actually made this point in their release. This was the rainfall in April was 55% above the historic average, and indeed in some parts of the country. Anyone from Edinburgh here? Well, Edinburgh had its second wettest April in 186 years. You had all the way back to 1836. There'd only been one wetter April. So that obviously had an impact on parts of the economy. Clearly, consumer-facing areas were hit quite badly. Construction contracted by 1.4% during the month. Manufacturing was off 0.9%. I think construction was the key one. You obviously had Storm Kathleen at the beginning of April, so you had parts of Scotland, Wales, Northern Ireland and the West Country battered by high winds. No surprise to see construction coming off accordingly. Now, that's last week. This week, and by the way, I should say, I think the economic outlook is slightly better than that. A lot of people seized on the fact that the economy flatlined in April, but in the 3 months to the end of April, you saw growth of 0.7%, so marking a slight acceleration from the 3 months to the end of March, which was 0.6%. And most economists that I talk to certainly expect to see the economy growing for the remainder of this year. And that's borne out in the PMI numbers, for example. There are several forward-looking pieces of data that we look at. One is the sort of Lloyds Bank economic surveys. Another is the Purchasing Managers Index survey data, published now by S&P Markets. One of the key things I look at every month. And if you look at the PMIs for May, they're pointing to a rebound in activity in all sectors, including, interestingly, manufacturing. And what was worth noting in the GDP figures for last week, the services sector, which don't forget is 4/5 of UK GDP, well, that actually has now expanded for 4 months in a row. So there is clearly something going on. Bear in mind what I said about weakness in consumer spending. It looks as though some of the growth that we're seeing over recent weeks months is being driven by business investment, which is something that we've not been able to talk about for a while. I should say, by the way, I've been asked to, if anyone wants to lob a question at me, as opposed to a boulder, use your Slido thing and I'll try and answer it. We've only got time for a couple because we're quite tight for time. So this week, we get the inflation figure. Now, obviously, the latest inflation number last time round was 2.3%, again, ahead of where the Bank of England's target is, the centre of that 2% target that the Monetary Policy Committee is mandated to hit. It feels like we're going to get down to 2%. That's certainly the way the market's betting right now. However, we've obviously got a Bank of England rate decision this coming Thursday, and I think, were we not in the middle of an election campaign, I suspect the Bank of England might be sort of hovering closer to a rate cut. We won't get one, but obviously we'll be looking out for what the composition of the vote is. 7-2 is the way to bet there. But as I say, if you look at some of the labour market numbers that we saw last week, the fact that whilst wage inflation remains strong, you've still got you had a contraction in employment last month. The unemployment number was up by 138,000, and that points a softening labour market. But how do you reconcile that with the fact that earnings growth is still relatively strong? Well, it's because we've got a skills shortage. It's one of the main crises, one of the main problems that face this country right now. So, as I say, I think given the GDP number that we had last week and the jobs number that we had last week, were we not in an election campaign, I think we would probably got a rate cut this week. As it is, you'll probably have to wait until August. The market is putting a 50-50 chance on there being a rate cut by now. Worth remembering, we've had a couple of rate cuts already this year elsewhere around Europe. The ECB went a couple of weeks ago. Before then, we had the Riksbank in Sweden and the Swiss National Bank. Both of those have cut interest rates already. And last week, we got a rate cut from the Bank of Canada as well. First G7 central bank to cut. They got in a day before the European Central Bank. So you are starting to see around the advanced economy world, you are starting to see monetary easing, which will obviously be pretty beneficial. In terms of the general election, well, do get your questions up, because otherwise we shall have to go straight to our panel. Crikey, they're all there. Right, which one guest on Sky News has been the most enlightening when analysing the economy? You're asking me to choose between my children here, you know. I mean, they're all. I'd say one of the ones that's been very, very good and always worth listening to, though we haven't had her on the programme for a while, was Karen Ward, who is at JP Morgan Asset Management. She's actually been doing some informal advising for the government. I would expect to see her on the Monetary Policy Committee at some point in the future. Another one, if you ever see him on, is my great friend Simon French. He's head of economics at Panmure Gordon, the investment bank. Very, very accessible, explains very, very complicated things in a very understandable way. And again, he's someone I wouldn't mind having a little bet. If you ever get a chance to bet on future MPC members, I'd have a little flutter on him. What impact would re-electing Trump have on the UK? I rather think that depends on who wins the general election. Well, we know that. Trump in the past has hinted that He's in favour of doing free trade deals. Although it's worth reminding, that didn't happen last time around. So, hopefully that is something that might materialise in due course, because there's been no indication from the Biden administration at all that there'll be a free trade deal with the UK. Although Trump is very, very transactional, and I suspect he will want all sorts of undertakings and guarantees, for example, on food standards. We all heard a lot about chlorinated chickens and the like coming into the UK grocery shelves. I suspect Trump will be looking to push on that. I suspect Trump will be very, very hard in terms of reinforcing the spending guidelines on NATO, whereby we're all committed to 2.5% of GDP on defence. Trump will expect everyone to meet that side of the bargain, and it's been certainly striking since Putin invaded Ukraine. The Europeans have, even the Germans, have started to put their hand in their pocket and spend more on defence. You'll notice I'm trying to leave aside all the sort of Sturm and Drang that you would get with the Trump administration and all the sort of associated chaos. How will a potential Labour government, I assume that says, impact business confidence in the economy? Really good question. I think that rather depends on whether they stick to everything that's in their manifesto. It's a rather vague document. There aren't too many firm commitments in there. So I think that's a really hard one to answer. Do we need negative inflation to start making a noticeable impact on financial vulnerability and poverty? Well, we've flirted with negative inflation in the past, and I don't think anyone wants to go back to that. And I certainly don't think it's something that either the Monetary Policy Committee will be trying to engineer, or indeed the next government. What sort of Chancellor will Rachel Reeves make? Well, this is, again, a really interesting question, because the room for manoeuvre that any incoming government has is really, really narrow. They've inherited a fairly tight situation on the fiscal side of it anyway, whereby there are certain spending envelopes that the current government is committed to increasing, most notably health, to an extent education, defence is the other one. But at the same time, those are largely being paid for by fiscal drag, the fact that we haven't seen these increases in thresholds on income tax. And Rachel Reeves inherits that. The key thing with Rachel Reeves is that she's committed to sticking to the current fiscal rules, whereby the deficit to GDP ratio is coming down at the end of the 5-year cycle. Sorry, the debt to GDP ratio. And basically, in the past, people like Gordon Brown was a great one for sort of fudging his fiscal rules. He put them in place, and then he was constantly fiddling with his own rules. Rachel Reeves is committed to sticking to the fiscal rules at the moment, as is Jeremy Hunt. That doesn't leave much scope for doing very much. According to the Office for Budget Responsibility, there's only £8.9 billion worth of wiggle room at the end of the 5-year cycle. And in the context of an economy where the government takes in £1.1 trillion every year, that is a rounding error. So there is very, very little room for manoeuvre. So the big question is, will Rachel Reeves stick to that, or will there be surprises? If they want to extend the funding envelopes, well, they're going to have to pay for it by taxes. I don't think borrowing is really feasible. So really, very big question, that indeed. Given the likely change of government on the 4th of July, how are you expecting the market to react going into 2025? Look, a Labour government is baked in. The markets are assuming that, whether that's the gilt market, the equity market, or even sterling. I think that's all in place. So where we go from there, it will depend on implementation. Rachel Reeves has already said that there will be no fiscal event in the first 10 weeks of a Labour government, in order to give the Office for Budget Responsibility a chance to go over the workings, and so they can give it the rubber stamp of approval. So you're probably talking September. By then you'll be into party conference season, so you might not get a fiscal event until early October. So will that really impact the markets between now and the end of the year? Probably not. But look, let's wait and see what else. The UK doesn't act in isolation. A couple of other market things that I should mention, which I think are really, really interesting, if you'll bear with me for a moment, is the fact that the oil price Well, we were all watching the markets, and we're all fascinated by the election campaign. Well, you might be. But the oil price last week hit its lowest level since the 5th of February. So it feels like the oil price is on a downward trend right now. And that potentially is pretty exciting in terms of putting more money in consumers' pockets. So that is something I'm looking out for. On the bond markets, the really interesting development, and this is actually right from what's been going on this morning, the spread between French 10-year bonds and German 10-year bonds has widened to 80 basis points this morning. Why is that? Because the markets are really, really nervous of what a new French parliament, we're obviously not going to get a change of president, but we are probably going to see Macron lose in his parliamentary majority to the far right, the National Rally, Marine Le Pen's party. They've come up with all sorts of outlandish spending promises, which is what populists tend to do. And the market is taking fright at that. I mean, some people are even saying this could be where France has a Liz Truss moment. So that's another thing that I'm looking out for. If you get instability on that front, you'll probably get instability in other corners of the bond market as well, including UK government gilts. And again, that will probably keep Rachel Reeves's hold her feet to the fire, to be honest. We are, as I say, running a little over right now, so I'm going to call a halt to this and invite our panelists to the stage. And we have, there we go, I can see one of them moving to the stage already. We have Emma Lovell, she's Chief Executive of the Lending Standards Board. Jonathan Steward, Chief Compliance and Risk Officer at Equifax. Chris Leslie, from the Chief Executive from the Credit Services Association, and somewhere I'm hoping Ryan Mendy, the Chief Commercial Officer at Zilch. Welcome to you all. Great, thanks very much, everyone. Emma, I'm going to start with you. It's probably a terribly old-fashioned thing to say in this day and age, but ladies go first. Almost a year into the Financial Conduct Authority consumer duty has been enforced. What are your observations on how things have gone?
Well, that's a very good question and a very open question, and I could spend a long time talking about it, but I think, look, I think it's fair to say, and probably quite trite to say, that it's been an absolute sea change in terms of financial services regulation, and the amount of work, time, resource, money that firms have had to put into implementing it has been pretty wide-ranging, and I think will continue to be so. I think what's interesting from my perspective is the FCA has been very clear on consumer duty, that it's not a once-and-done approach to implementation, and it's been an interesting first year of embedding the duty, but there's going to be far more to come, I think, in terms of the FCA's priorities and where they take that over the next 24 months beyond first implementation.
I mean, Steve, we're 10 years on from the launch of the FCA. How would you characterize the relationship right now between the regulator and the regulated?
Who are you asking?
Steve.
Steve. But if anyone wants to take it, you're all...
Sorry, is that for
yes.
me? Okay. I think...
Sorry, Jonathan, good heavens.
Yeah.
Why don't you answer to the name Steve?
I'll take it, though. I think the one thing I feel has changed in terms of regulatory relationships is that there may have been a perception years and years ago that you share what you have to with the FCA and that's it. Mm-hmm. You know, you ask the question, you answer it, and that's it, almost like you're being audited. And I think, having had a very, very close relationship with the FCA over the last 5 or 6 years, I think that's really moved. And, you know, I appreciate a lot of people think, you know, you shouldn't overshare. Well, I sort of disagree with that now. I think that, you know, it's a partnership. It's not a them and us situation anymore. We're all in the market. We're all responsible for the market. And I think that I've certainly felt that the building of trust and confidence in the relationship with the regulator, it requires you to share more than you do, whether that is, you know, they come along once a year and ask about your complaints data, and then it's been 18 months since they've asked about it. Well, why don't you ask them? Do you want to see our complaints data? If it's great, you've got a good story to tell. If it's bad, you're probably going to have to tell them anyway at some point, so do it on the front foot. But I think that transparency backwards and forwards, that sense of trust is building. And I certainly feel it's a very, very different situation compared to 5 to 10 years ago, especially for those firms that have moved through into FCA authorization in the last 10 years.
It's a moot point because, when Martin Wheatley became CEO of the FCA, he said he was going to shoot first and ask questions later. Do you think the attitudes have softened since then?
Yeah, I absolutely agree. I think that I feel, I think if I go back 10 years myself, it was probably quite an intimidating experience going to see the FCA, being interviewed, being spoken to by the FCA. But, it's like any relationship in any walk of life. You've just got to work at it. And, I think, I know infinitely more about our supervisor now, in terms of you want to be able to talk about how are the kids doing, how's the dog, how was your holiday, and know about that. And, when you have a regular supervisor, it does help. But equally as well is it's almost like we as a market need to anticipate what their next question is going to be. And if we can anticipate that and work with them on that, it makes a heck of a difference.
Chris, we haven't had any major enforcement cases yet under Consumer Duty. Are you surprised?
No, not really. I think actually, of all the various sort of sectors in the economy that are sort of subject to regulation, credit and finance is doing pretty well. The whole global financial crisis really shook the sector by the scruff of the neck, and a lot of the worst excesses, as you might call it, were actually dealt with pretty well. I don't necessarily think that the wider public and the media see that. I think if we look post-election, we'll probably still see financial services occasionally being the whipping boy for a lot of the policymakers. But the FCA have phenomenal amount of powers now. The Consumer Duty, I think, is almost like a quasi-legislative power. It's a sort of decision to take a remit across pretty much anything that it wishes to look for. It hasn't prescribed in advance the offences that it will punish people for. It's basically saying, we'll know bad practice when we see it, and then we'll come and admonish you for having strayed over a line that we didn't necessarily predetermine. So far, we're all sort of waiting and watching to see who is going to have the sort of black spot put on their corporate circumstances. And I do slightly criticize the FCA for perhaps being a little bit aloof on this issue. To a lot of people, a lot of the sector have adapted to Consumer Duty really well. They're going through, of course, the annual reviews that they're putting in place at the end of the month. But at the end of the day, this is still quite a gelatinous, uncertain creature. And I think putting a bit more flesh on the bones about where the limits are of regulation is going to be quite important. And you might come to this later as well, because I think that FCA themselves are sort of waiting and holding back to see what appetite there will be from the new government for intervention generally. So they're sort of hanging back a bit themselves, even taking the PERDA period quite seriously.
Yeah, good point. Well, Ryan, maybe you'd like to throw some thoughts out there on what you expect to see from the next government.
Well, I think one thing we'll know in 18 days, is it? 18 days until Independence Day, I think they'll call it as well, is whomever is in the driving seat, right, and they're in there for 5 years, and that's what they're fighting for. We're all still got the hustle to do, run a business daily. That's ultimately what we've got to do. So whomever is in the driving seat, I think we should zoom out and actually take a look at actually what they're actually going to gain as the prize. They're going to gain $1 trillion tech sector. And the majority of that is a fintech sector. And when you take a look at this sector, one of the things that you realize is that there's not a lot of clarity. And I think that's easy to understand as well, because if you just take a look, I think for anybody who's in the industry, the reality is that technology always blazes a trail before regulation. You can't regulate something that doesn't exist. And I think we know that for trying to tell our children how to behave and so on and so forth. So I think the reality is that what we're calling for is absolute clarity, extreme clarity. Because when you think about it, if you take a look at that, for instance, the FTSE 100, you're answering questions on the market. I've been in the market for about 30 years now. And when I look at it, like from doing about 100 IPOs and all that sort of stuff, one of the realities is that when we founded Zilch 5 years ago, if you think about it, we've gone from 0 to creating over 3 billion of sales, about to break into hundreds of millions of revenue, break profitability. But at the same time, we're one of the only regulated companies of our kind in the entire UK. We're actually the only UK at-scale company that decided to get regulated before we even launched, because safeguards for consumers are good. And the reality really comes into then is what we're saying is next government, make it simple. Just do the right thing and actually regulate buy now, pay later within the first 100 days. It's very simple to do. Des, our CRO here, he's going to be speaking on this subject. But this is the simple thing. So we're actually just asking for absolute clarity, because the FCA is ultimately the gold standard. When we travel around the US and et cetera, the FCA is regarded as the gold standard in regulation. And so we've got an opportunity in this next government, if you will, whomever they are, to actually get things right, think bold and have a bigger vision, but do something audacious, because they actually might probably get 2 terms, 10 years, who knows, right? But the reality is that it's a good opportunity to get that one thing that's probably missing and being criticized at the moment, growth.
Yeah.
And growth ain't going to come by October, by King's Speech. That's going to take some time.
Absolutely. Well, we'll get on to that. I'm sure, by the way, any FCA people in the room will doubtless be very pleased at what you've just said there. Emma, we're talking a lot about consumers here, but you have concerns about SMEs as well, and how they are regulated, lending to them is regulated.
Well, I think so. Sort of SME lending in particular, but financial services products. I think clearly there is an overlap there between the consumer duty perimeter, or the FCA's wider perimeter, and SME lending. But from our experience at the LSB, I think there really does have to be care to be taken in ensuring that SMEs as a distinct group have their needs and any vulnerabilities that they might have assessed on the basis of being an SME rather than a retail personal customer. Now, I'm not saying it's not right that there's been a move of consumer duty into processes across different firms which may cover SME customers, but I think we have to be very clear that some of the issues affecting SMEs, some of the concerns around lending to them need to be addressed distinctly rather than assuming consumer duty is the answer to SME customers' needs rather than purely personal customer needs.
And I mean, Chris, is that possible, this sort of one-size-fits-all approach almost?
Well, you do sometimes get the impression that the FCA are kind of eyeing up issues beyond the perimeter that Parliament has set for them. And many of you will have already had well, there's lots of surveys come out from the FCA out there, but there's another one, I think, this last few weeks, which actually was interesting because it sort of started to specify what areas of unregulated activity do you work in, can you list the name of the firms of your clients, quite intrusive areas. And, some people might say, well, actually, what's going on here? What exactly are the FCA doing? And, asking questions about utilities and so forth. And I don't know whether there's a bit of jostling between the various regulators. Will Ofgem sort of say, "Oi, FCA, get off our patch," or whatever? But you do get that sense that the FCA are, as you say, they like to see themselves as the gold standard and are looking at increasing. And heaven knows their fees and levies are large enough to expand the number of staff that they have across all that area. But coming back to your point, if Rachel Reeves is right that growth is going to be the only main source, for revenues in the future, we can talk about tax another day, but if growth is it, then you have to deliver certainty for investors to come into, including financial services sector. Without that certainty, a lot of investors are saying, what am I getting into in the UK? Am I going to put some money behind something that might serve near prime or subprime, and then all of a sudden it's going to get slapped over the wrist and you're going to get bombarded with FOS complaints and all that kind of stuff. Investment certainty does link to a regulatory environment that is predictable, but also quite confined as well. And I think sometimes our sector does need to be a little bit more assertive in demanding that sort of environment.
Jonathan, I'd like to get your response to what Chris has just said there.
Yeah, I think it's interesting because just perusing the Labour manifesto the last couple of days, there's obviously a big section on financial services. And, I think a lot of the things they flagged in it, some of it is probably organic growth anyway. They talk about, obviously, sustainability, diversity, talk about investment in fintech and innovation. But I sort of reading through it, my mind kept coming back to, how does it get paid for? If they expect the regulators to take these big strides and to move more quickly than they have done, then how are they expecting to do that? Because with the best will in the world, the FCA, I'm sure would admit themselves, they don't have the funding to do everything they really want to do. And to your point about pacing as well, you've got to take the market with you. And, I think about some of the things they're looking at, obviously some more social engagement type subjects. We're expecting to see, obviously, some protocol or directive on ESG, diversity inclusion, things like that, which are great things to do and things that we should be doing anyway, but they're probably already moving. But what is the expectation of how quickly they expect these things to move? And the risk is that in certain sectors is that, if you talk about the use of AI or other technologies, will the market move too fast for the FCA to be able to keep pace with? Because, we've seen buy now, pay later become such a huge part of the credit industry. But the FCA still, I appreciate that's influenced by the government, still not at a point where they're really getting their arms around regulation of that sector. Labour have called that out in the manifesto, so I get that. But it'll be interesting to see how pacing and funding applies to that.
You're saying that... Oh, go on, Emma.
No, I just wanted to pick up on that latter point about pacing. I realise the point about statutory regulation, there's always a lag. It can take a while to catch up. But I think there is an opportunity for industry, in whichever part they see where there is a gap in statutory regulation, to grab the bull by the horns and say, actually, as an industry, we can make commitments before there's statutory regulation to improve protections for customers, to address what's perceived to be the emerging or new risk to customers, and embrace that. And therefore, you've got a win-win. You've got something that's protecting customers that industry is voluntarily committing to, but that also can be moulded and shaped to work for that part of industry. So I think statutory regulation will come, but I think there are various opportunities, and the LSB as an organisation is a living example of that, where industry can come together voluntarily and put protections and quasi-regulation in place, which may never stave off statutory regulation completely, but at least shows how things could evolve much more quickly and potentially more agilely than waiting for statutory legislation to come.
It influences the policy piece, really, doesn't it?
Exactly. Yeah.
Ryan, do you think there are inherent contradictions in the FCA's brief? Because it's not only supposed to protect customers, it's also supposed to be promoting competition within the industry and promoting the industry itself now. Are those inherently contradictory, those aims?
Yeah, I think, I think it's a bit like, it does really bring about a thing that I try to remember, and that's that anything hard you're trying to do, the magic is always behind the work you're not doing. And if you do think about it, people therefore, I'm sure everybody has, but I'm sure not everybody knows exactly what their 4 values are that they've come up with their company. But the reality is the bigger the mission, the greater the vision, clarity, what you need. And if you look at the values of the FCA, what are they? I'll tell you what one of them are. It's to ensure there are no bad actors, right? They're the monitor. Who runs those? HMT, and then under that organogram is HMRC, is LSEG, and then obviously the FCA. Now, what comes under the FCA, and I think this game comes into clarity, it's a bit like the PSR. They do lots of jobs, and then they announce things. That's confusing to some people because they look to the FCA. So therefore, you could obviously make that simplified. The nickel comes out with a big statement, and everybody understands, okay, great, that's the guiding rule. So the reality is that if there's supposed to be no bad actors, well then just take a look and take a stock of what's going on in technology at the moment. It's outstripping growth massively, like 5x, compared to the current companies that are fully at scale. And so what they have is probably one of the greatest opportunities in multi-generations to actually get the keys to what is the Treasury Office and do some really innovative stuff. Clean up open banking and clean up open finance. I ask anybody here, who knows exactly what the difference is, black and white, what the difference is between open banking and open finance? I sat in a room recently with many CEOs and and ministers as well.
Okay.
And they didn't know. So there's a really great opportunity to get some extreme clarity going on, so that what we can do is continue to actually scale, grow, and make sure that consumers are protected, because consumer duty hasn't come about just overnight. It's been properly baked in. The problem is how actually adaptable is it to certain companies. To our company, we've very adapted to it since last July when it came in force.
Okay, we've got a few questions that have come in from the audience. Thank you for those. We'll go to the one at the top. When does wide-ranging regulation such as consumer duty, PS 24.2, 24.3, the FOSS, etc., compete unhealthy barriers to entry? Who wants to have a stab at that one?
I mean, it was very much the point I was sort of emphasizing before. If it's unclear, if it feels burdensome or a deterrent to investors, then it is becoming a barrier to entry. It's a bit motherhood and apple pie-ish, right? Consumer duty, who could oppose it? It has got lots of good, virtuous aims and objectives within it. And a lot of the firms I see across the sector are really striving very hard to meet what they need to do for those regulators. But, you know, the regulator is now going down a route of very granular demands on data, customer by customer by customer, with this product sales data requests, becoming almost a credit reference agency in its own right. Now, what's that about? Where's that going? The notion of a data-led regulator is all well and good, but the phenomenal amount of analysis that they're going to need to get any intervention correct versus the amount of error that could be involved is massive. And, take, for example, the proposal from the FCA on publicizing early investigations. Now, there was a big furore about that. A lot of the sector did actually speak up and push back, even government ministers. Even the Labour Party was sort of saying, we'll review. They're not saying a massive amount on these things. And we'll wait to see what happens in September on that. But again, if you're an investor or wanting to enter into this sector, and you see the regulator saying that they may publicize an investigation, which, by the way, on average can take something like 48 months to conclude, and even then 70% of them don't end in any enforcement action. That is a big black cloud that hangs over anybody thinking they're going to put investment in our particular sector.
We've only probably got room for one more, but since Emma, there's one specifically there for what is the LSP view on BNPL? Have you invited BNPL lenders to sign up?
So BNPL, interesting example. It is absolutely the kind of area that I was alluding to earlier, where voluntary commitments, voluntary standards for a particular part of market that aren't subject to full statutory regulation would absolutely lend itself to improving customer protections. The issue at the moment is obviously Treasury have undertaken their first stage of the Consumer Credit Act review, and with PERDA having happened, we are just waiting for the result of that and their direction of travel. But absolutely, it is something that BNPL lenders could sign up to the personal standards and or a variation of that, and we would absolutely welcome that as part of our purview.
Brilliant, thank you. We've had some great questions in here. I'm sorry we haven't got time to answer them all, but do pounce on these good people, and maybe they'll, if you want to get their personal attention. Emma, Jonathan, Chris, Ryan, thank you very much indeed.
Good.